This chapter we will talk about the mathematics of selling. So now what we're trying to do is to set our selling price. So the formula that we use is our selling price is equal to our cost plus our markup. So the selling price is obviously what we're selling the product to the consumers for. The cost is what we've paid. So let's say we're a retailer. If you're a retailer, you still got to go out and buy the product yourself. The cost should be significantly lower than the selling price, we hope, if we're going to make money. If we're a manufacturer, we would make that product and then we would sell it, to probably to businesses. Our markup is going to be enough to cover our operating expenses and our profit. So again, remember when we're setting the selling price, this is like our ideal selling price. So we're going to sit down and say, well, what do we expect those operating expenses to be and how much profit would we like to have? When you go to do your homework, you may have problems that break that markup into those two. They might say you need 15% of cost to cover operating expenses, and then they want 10% of cost to go to profit. So then you've got to add those two together. You got to know that that's what, those two combined are our markup. Then our markup, so if we sometimes then we'll have it go the other way where maybe they give us, they'll probably still give us, we'll still probably have to go through the selling price equals cost plus markup to find out what those are. But then there's some more simple ones that might just say, hey, the cost is such and such, and the markup is a percent of that cost, 15% of that cost. And then those you are just going to multiply. You take that 15% times the cost. Now, the one section we'll talk about, well, what if the markup's on selling price? So if they give you the selling price, then that's easy. It's the same way, just that percent times the selling price. If they don't, then sometimes we'll have to go back into our formula and say, okay, our selling price is our cost plus our markup. If we know what cost is, but we don't know selling price and we don't know markup, as long as we know the percent, we can still fill it in, and then we'd have the missing variable as our selling price, and then the markup is going to be a decimal or a percent times that selling price, and then we can still solve for what it is. But those ones can be a little bit trickier. Then a lot of times at the end of the problem, they're going to ask us, what is that markup as a percent of? And then I'm, leaving that of because it could go as a percent of cost, or it could say the equivalent markup percent of selling price. So basically what you're doing is you're taking the markup dollar amount and you're either going to divide it by the cost or you're going to divide it by the selling price. So just read it carefully to know which one you're dividing by. Sometimes also in the homework, they might say, well, what's our cost as a percent of selling price? Then that you just take your cost and you divide it by your selling price. So always read those to determine anything that's a percent of is telling you you're dividing by what follows the of. So sometimes students do struggle with these though. What I like to do is always start with the first formula, selling price equals cost plus markup, because it's just addition and subtraction. If I have two of those, which many times I do, all you do is subtract to get the missing one. So to me, that's super easy. Just again, read it, start with that one. And then once you have all three of those, there still might be other things they ask for. You know what I mean? So, but that's always my starting point, because in that way I've identified my selling price, my cost, and my markup. Now say I read it and I really don't have two of those. I can't solve for that one. Then go down to that markup. So markup is either a percent of cost or it's a percent of selling price. And then see if you can solve for that, because then at that point you would then have two of them, because then you'd have the markup and you're either going to have cost or you're either going to have selling price if you could complete that one. Again, then you can kind of move through that next formula, or that back to the selling price equals cost plus markup, and get all three of them. And then, like I said on the last slide, sorry, I think I spelled percent wrong on this slide. But if you're asked for that markup as a percent of cost or selling price, you're going to divide by whichever one it says. Then there's some unique scenarios that, like say you work in a grocery store and you're in the produce department, or you work at a farmer's market and it's all food that's perishable. those vendors or stores know that some of those products are not going to be sold. They're going to spoil. They're going to have to throw them out. So that when they initially set the selling price, they go into it knowing that not all of the goods are going to be saleable. So we'll calculate our selling price the same way we do. Selling price equals cost plus markup. But then we'll determine, well, how many are we actually going to sell? So maybe we know 10% of the apples are going to spoil and be thrown out. So we want to subtract that 10%. We want to figure out or calculate the 90%. How many are actually going to be sold? Then we take the selling price that we want and divide it by the saleable goods. And that will give us our price per unit. But then what about the end of the season? So we're past Christmas and it's the first couple weeks of January. Everything's marked down. And we do love markdowns, right? I mean, people are always around those clearance racks because you're getting good deals. So sellers have to prepare themselves for that as well. So we sell it at a reduced price. So the reduced price is the original ticket price minus the markdown. And the markdown is always going to be a percent of the selling price. So that at least is a little bit easier. With the markup, we didn't know. Could be a percent of cost, could be a percent of selling price. We have to read it carefully. Markdown is always on the original selling price. And then if they asked us to calculate the markdown as a percent, then it's going to be the markdown dollar amount divided by the original selling price. Again, you don't have to worry which one is it. It's always the original selling price. So if we had a product that was originally selling at $960 and we marked it down 25%, again, just multiplying those two gives you the dollar amount of the markdown. But then remember, we got to subtract it. So the actual reduced price is the original price minus the markdown. If it didn't ask for both of the things, you could also go back to what we did like in our last chapter and use our complements and say, well, if we're saving 25%, we're paying 75%. And you could multiply that 960 by 75% to get to that reduced price. But sometimes it'll ask you for both, in which case then you might as well just take it in the two steps. When we mark a product down, then the textbook likes to ask, well, are you making money or are you losing money? Because again, go back to the very start of the chapter, we set that selling price to cover our operating expenses and to provide profit. So if we now take that selling price below, are we actually having, are we covering those expenses or are we having a loss? So these will be the four things that could happen. So again, you won't have all four of them in the same problem because obviously some of them are losses and some of them are profit. But if our selling price still covers those operating expenses, so if it covers the cost of the product and it covers our operating expenses and there's still a little bit of money left over, then we actually have a profit. If our selling price, our reduced selling price covers the cost and the operating expenses, but nothing else is left, they call that the break-even point. So we have zero profit, but at least we're covering all of our costs. And the textbook likes you to kind of compute that break-even point and know what that break-even point is. So then if we sell it for less than that break-even point, we're going to have an operating loss. If we sell it less than our cost itself, then we have an absolute loss. So say I'm a retailer and I am selling a sweater for $10, but I actually paid $15 to get that sweater. So I'm actually losing $5 by selling it at $10. That's an absolute loss. Now my loss will get even bigger because I still have to pay my operating expenses. So my operating loss will be bigger than my absolute loss. And I like to set it up again because I'm an accountant and I teach financial accounting as well. I like to kind of set it up like in the income statement setup. So you've got your selling price, which would be equal to your sales, less your costs, which again, comparing this to financial accounting, that would be your cost of goods sold. If we have a positive number, that's our gross profit. If we have a negative number, again, our selling price is less than our cost, we have an absolute loss. Then we're going to subtract out all of our operating expenses. And again, if it's positive, we would have operating profit. If it's negative, we have an operating loss. So again, I like to try to combine the concepts that we're learning here with financial accounting. But you can also set it up kind of like how the textbook does in the formula and calculating the break-even point and stuff like that. But again, this is kind of how it would set up if we were thinking about it in terms of an actual income statement. Then we have our inventory turnover ratios. So those are fairly easy. They should give you these. You just have to know the formula. So if it's at retail, we'll have retail sales divided by our average inventory at retail. If it's at cost, it will be our cost of goods sold divided by our average inventory at cost. So the inventory turnover, again, could be calculated two different ways depending on is it at retail or at cost. So just pay attention to that part. And then companies track inventory. If they use a periodic method, which is a little bit more old school, they're going to take multiple physical counts and then compare that to what they think they have and then make adjustments. A perpetual is much more common in today's world. You know, everybody's using barcodes and UPCs and everything's computerized. So, you know, they're scanning it as the product comes in and then they're scanning it as they sell it out. So then, granted, none of that is ever going to be perfect because product gets damaged, it gets stolen, it gets maybe, you know, misrung or whatever. So it's never going to be perfect, but it's definitely a lot more computerized and probably accurate than you know, constantly taking those periodic physical counts. So then it comes to this, well, how do we value that inventory? So again, if that inventory is coming into us, we're a retailer and we're buying it and we get, you know, just shipment after shipment coming in. And it's maybe, you know, so say we're an appliance store. It's all these refrigerators and stoves and microwaves and TVs and whatever we're getting. And they're coming in all year and they're being sold all year. So how do we value those? Specific identification would be if we really truly did do those barcodes. So if we said, hey, this product came in, that exact product went out. So we knew if the barcode was specific to the TV or whatever, but it's probably not. It's probably specific to the brand. You know, like this is a certain brand and this is what we sell it for. It's not specific to that refrigerator itself. If you were selling like cars or something that have identification numbers, then that would be an easy one to do, the specific identification. But probably most of our consumer goods at our retail stores are not done that way. So then you go down to our other methods. So weighted average is when you find the total cost of all of the items that were in your inventory, whether they were in the beginning inventory or we purchased them. We add those all together price-wise, and then we divide it by our total quantity, and we get an average price per unit. And then we're going to use that average price per unit to value what's left in the ending inventory and also to value out the cost of goods sold. It'll ask us here just what is your value in an ending inventory. In financial accounting, we'll look at, well, how does that carry forward then to our cost of goods sold? First in, first out says our first units, sorry about that, our first units that we purchased are the first ones that we sold. So that would be our beginning inventory would be sold first. Then the inventory that we bought in January would go next. You know what I mean? It's just going to go in that order. So if we're at the end of December and we're trying to value our ending inventory, we look at the most recent purchases to total up how much is left in our ending inventory. And then our last in, first out is the reverse of that. It says the stuff that we just bought is what was sold. So then we're going to be left with all of our old stuff in our ending inventory. So here's a little schedule. So the top part is the history. So we had a beginning inventory of 20 units at $70 price. Then we made these different purchases throughout the year. And then our last line there are our totals. So we have 270 units that we have handled, and we have $22,500 of costs associated with those units. So the weighted average, we just divide those to get to our cost per unit, and then multiply it by the units left in ending inventory. First in, first out, we say, okay, these first ones are all sold, so we're left with these bottom two. So the July purchase, or sorry, the October purchase of 40 is at $75. And then we don't have all of the July purchase left. We have 35, again, because it tells us that there's 75 in inventory. So then those 35 are valued at $85, and then that's our cost. And then the LIFO goes the other way to say, okay, what's left is these very beginning ones. We've already sold the October and the July and part of the March. So we've got 20 from our beginning inventory, we've got 50 of those January ones left, and then only 5 of the March. And then that's how we value our ending inventory. So then you can see we end up with a little bit different total. They're not super far apart, but just based on which method we're using, they're going to be valued just a little bit differently. And then that is it for our selling. But this is a hard chapter. There's a lot in it, so please take the time to kind of review that.